Ludwig von Mises predicted the 2008 financial crisis in 1912. No, that's not a typo. 96 years before Lehman Brothers collapsed, before subprime mortgages even existed, before the Federal Reserve had been created, Mises wrote the theory of money and credit and laid out exactly, and I mean exactly, how central banks create artificial booms that must end in devastating busts. Here's what's astonishing. He didn't just predict that one crash. He predicted the 1929 Great Depression, the 2001 dot-com bubble, the 1970s stagflation, the 2020 everything bubble we're living through right now. How? Because Mises wasn't guessing about the future. He discovered the mechanism, the actual cause and effect process that turns good times into economic catastrophe. And you know what's crazy? Right now, as you watch this, that same mechanism is running. The Federal Reserve has done exactly what Mises warned against. The artificial boom he described is inflating all around you, in housing prices that make no sense, in a stock market that ignores reality, in the easy money that somehow makes everything more expensive instead of more affordable. You feel it, don't you? Something is off about this economy. The mainstream experts on CNBC tell you everything's fine. Unemployment is low. Markets are strong. But your grocery bill doubled. Your rent is crushing you. Houses in your neighborhood sold for $300,000 5 years ago now cost $650,000. And you're supposed to believe that's growth? That confusion you feel, that sense that the numbers don't add up, that something artificial is propping everything up, isn't paranoia. It's pattern recognition. You're sensing what Mises could see clearly, the difference between real prosperity and a central bank-induced illusion. What if you could see through the fog? What if you had the exact framework Mises used to predict every major crash of the last century? Not to become a fortune teller, but to understand what's actually happening to your money, your savings, your future right now. That's what we're doing today. I'm going to teach you Austrian Business Cycle Theory step by step, not as academic exercise, but as a diagnostic tool you can apply immediately to today's economy. By the end, you'll be able to identify boom conditions, understand why they must end, and position yourself accordingly. I know economics feels overwhelming. You're not an expert. You didn't go to business school, and the PhD economists speak a language designed to exclude you. That's intentional, by the way. Complexity is how they maintain authority, while being consistently wrong. But here's what Mises understood. Economic truth isn't complicated. It's logical. It follows from basic facts about human action that you already know from living your life. You understand cause and effect. You know that you can't spend more than you earn forever. You recognize the difference between real value and inflated prices. Mises built his theory on that common sense, then showed how central banks violate those basic principles and create disaster. You're about to learn not just what Austrian Business Cycle Theory is, but how to use it as a lens for understanding every economic headline you encounter. If you want to cut through the economic propaganda and understand what's really happening to American prosperity, subscribe to this channel where we translate Mises' rigorous economic thinking into practical wisdom for your life today. Before we dive into Mises' formal theory, let's start with something you already understand intuitively: the difference between real growth and fake growth. Imagine your neighbor suddenly starts living large. New BMW in the driveway, expensive restaurants every weekend, designer clothes, home renovation. You're happy for them. They must have gotten a raise, right? Then 6 months later, you see the repo truck taking the BMW. Foreclosure notice on the door. Turns out it wasn't a raise. It was credit cards. They were spending borrowed money. And when the bills came due, the illusion collapsed. You knew it wasn't sustainable, didn't you? You might not have said anything, but something fell off. That's because you intuitively understand this principle. Prosperity built on debt isn't real prosperity. It's temporary. It creates the appearance of wealth while building toward inevitable collapse. Now scale that up from your neighbor to the entire American economy. Mises saw that what's true for individuals is true for nations. When a central bank floods the economy with easy credit, artificially low interest rates, printed money, expanded lending, it creates the same illusion on a massive scale. Businesses borrow to expand. Consumers buy houses and cars they can't really afford. Stock prices soar. Everyone feels rich. But here's the thing. That wealth isn't built on real savings, increased productivity, or genuine innovation. It's built on newly created money and artificially cheap credit. Just like your neighbor's BMW, it feels real until the bill comes due. You're living through this right now. Since 2008, the Federal Reserve has kept interest rates at historically unprecedented lows. They've printed trillions of dollars. They've purchased government bonds and mortgage-backed securities on a scale that would have seemed impossible a generation ago. And what happened? Asset prices exploded. Houses, stocks, even Bitcoin. Everything went up. Was that real wealth creation? Did America suddenly become twice as productive? Did innovation double? Or did the money supply increase? And all that new money chase the same amount of real goods, bidding up prices? Notice how this works in your actual life. Your salary might have increased 5% over the past 3 years, but your rent increased 20%, groceries up 30%, used cars up 40%. The good economy the government celebrates feels like you're drowning. That's because they measure different things than you experience. They count the stock market boom, which helps people who own stocks. They count GDP growth, which includes all that borrowed money being spent. They celebrate low unemployment, while ignoring that wages can't keep pace with prices. You, meanwhile, count whether you can afford a house, whether your paycheck covers your family's needs, whether your retirement savings will actually provide security or evaporate when this bubble pops. Mises built his entire theory to answer one question. Why do modern economies experience this pattern of boom and bust? Why do euphoria followed by crash? Why can't we just have steady, sustainable growth? And here's his revolutionary answer. Because central banks create artificial booms by manipulating interest rates and credit, the boom feels good. Everyone's making money. Everything's growing. But it's not sustainable, any more than your neighbor's credit card spree was sustainable. The bust isn't a random external shock. It's the inevitable correction when reality reasserts itself. The reason you need to understand this is urgent. Every signal suggests we're in the late stages of an artificial boom right now. The longest bull market in history. Asset prices at levels that make no fundamental sense. Debt at catastrophic levels, government, corporate, and personal. The exact conditions Mises identified before previous crashes. Let me teach you how to see what he saw. Here's your first diagnostic tool. When Mises analyzed an economy, he started with one question. What is the central bank doing to interest rates and credit supply? This matters because interest rates are supposed to be a price, the price of borrowing money over time. And like all prices in a free market, they convey crucial information and coordinate economic activity. Think about how prices work at your grocery store. When strawberries are in season and plentiful, the price drops. That low price signals to consumers. Buy strawberries now, they're abundant. It signals to farmers. Maybe plant less next year. The market's saturated. The price coordinates millions of independent decisions without anyone being in charge. Interest rates work the same way, or they should. When lots of people are saving money, putting funds in banks, the supply of loanable money increases. Interest rates naturally fall. That lower rate signals to entrepreneurs. Capital is available. This is a good time to borrow and invest in long-term projects. Conversely, when people are spending rather than saving, the supply of loanable funds decreases. Interest rates rise. That higher rate signals. Capital is scarce right now. Maybe delay that expansion project until more savings are available. This is natural market coordination. Interest rates reflect reality, the actual supply of real savings available for investment. But here's where central banks destroy everything. The Federal Reserve doesn't wait for real savings to accumulate. They artificially lower interest rates by creating new money and purchasing bonds. They expand credit not because people save more, but because they literally fabricated it. Look at what happened after 2008. The Fed dropped interest rates to nearly zero and held them there for 7 years, then briefly raised them, then dropped them again during COVID. Right now, even after recent increases, real interest rates after inflation are still extraordinarily low by historical standards. What signal does that send to entrepreneurs and businesses? Capital is abundant. Borrow and expand. But that's a lie. Real savings didn't increase. The Fed just printed money and called it capital. Here's your first practical application. Go look up the federal funds rate right now. The Fed publishes this data freely. Is it below the historical average of 4 to 5%? Then you're in artificial credit expansion. Are they also doing quantitative easing, buying bonds and injecting money into the system? That's additional expansion. You don't need an economics degree to check these facts. The St. Louis Fed has a website called Fred with all this data in simple charts. Look at the M2 money supply, the total amount of money in the economy. Notice the vertical line starting in 2020? That's trillions of dollars created from nothing. That's step 1 of Austrian Business Cycle Theory. Identify that the central bank is manipulating rates and expanding credit artificially. Now, why does this matter? Because artificially low interest rates create a systematic pattern of malinvestment across the entire economy. Remember, interest rates are supposed to tell entrepreneurs which projects make sense. High rates mean only invest in projects with quick, certain returns. Low rates mean you can afford to invest in longer-term, more speculative ventures because borrowing costs are minimal. When the Fed artificially lowers rates, they're sending a false signal. They're telling businesses long-term projects are viable now when real savings don't actually exist to support those projects. So what happens? Businesses overextend. They borrow cheap money to build new factories, develop new products, hire more workers, expand into new markets. Consumers borrow cheap money to buy houses, cars, appliances. Everyone's spending, building, investing. It feels like prosperity. Employment is high because all these businesses are hiring. Stock prices boom because earnings look great. Real estate soars because loans are cheap and everyone's buying. But it's built on a foundation of fabricated credit, not real savings. You can see this in your own city right now. Notice all those new apartment complexes going up, new shopping centers, office buildings. That's cheap credit at work. Developers could borrow at historically low rates, so they built. Whether there's actual demand for all those units, whether real market signals justify that construction, becomes secondary to we can get a loan at 3%. This is the boom phase Mises identified, and you've just learned how to spot it. Now that you can identify artificial credit expansion, step 2 is recognizing what that expansion does to the economy's structure. This is where Mises' insight gets really powerful. He noticed something crucial. Cheap credit doesn't affect all parts of the economy equally. It systematically distorts investment towards certain sectors, specifically long-term, capital-intensive projects that are far from final consumption. I know that sounds technical, so let me make it concrete with something happening right now. The housing market. Building houses is a long-term, capital-intensive process. You need to buy land, get permits, hire construction crews, purchase materials, build the structure, all before you see a penny of return. This process takes years and requires substantial upfront investment. In a natural economy with market-determined interest rates, this only makes sense when there's genuine demand for houses and available savings to fund construction. Builders calculate, at current interest rates and expected sale prices, will this project be profitable? But when the Fed artificially lowers rates, suddenly those calculations change. A project that wasn't viable at 7% interest becomes attractive at 3% interest. So builders massively expand construction. Look at what happened from 2020 to 2022. Mortgage rates dropped to historic lows. under 3% for a 30-year fixed loan. Housing construction exploded. Prices soared. Buyers stampeded into the market because monthly payments were so cheap. Was that real demand? Did Americans suddenly need millions more houses than before? Or was it demand created by artificial credit conditions? Mises would tell you to look at what happened when rates started rising again in 2022. Housing demand collapsed. Construction slowed dramatically. Prices began falling in many markets. Why? Because the demand was never organic. It was rate-sensitive demand induced by manipulation. This same pattern appears across the economy. Notice which sectors boomed during the easy money era. Technology startups that burned cash for years before profitability. Growth stocks with no current earnings but promises of future dominance. Cryptocurrency and NFTs, commercial real estate. Private equity leverage buyouts. What do all these have in common? They're long-term bets that only make sense when borrowing costs are negligible. They're exactly the malinvestments Mises predicted artificial credit would create. Here's your diagnostic checklist for Step 2. Sign 1. Capital flowing to increasingly speculative ventures. When you see venture capital funding companies with no path to profitability, investing in moonshot ideas that might pay off in a decade, that's malinvestment. Real savings would demand more certain returns. Sign 2. Asset prices disconnecting from fundamentals. When houses cost 10 times median income instead of the historical 3 to 4 times. When stocks trade at price-to-earnings ratios twice the historical average. That's not value discovery. That's too much money chasing limited assets. Sign 3. Debt levels exploding. Check corporate debt levels. Student loan debt, government debt. When cheap credit is available, everyone borrows. Total U.S. debt government corporate household is now over 350% of GDP. That's not sustainable. That's malinvestment on a civilization-wide scale. Sign 4. Zombie companies proliferating. These are businesses that can't cover their debt payments from operating earnings. They only survive by refinancing at low rates. The Bank for International Settlements estimates that 20% of U.S. corporations are zombies. They should fail, but cheap credit keeps them lurching forward, consuming resources that could go to viable businesses. Sign 5. Resource misallocation you can see. Remember all those WeWork offices? Bird scooters on every corner? Food delivery apps that lose money on every transaction? Those are real resources, labor, materials, time, being consumed by business models that only exist because someone could borrow money at 2%. You don't need sophisticated economic analysis to see this. Just ask yourself, does this business make sense? Could it exist without access to cheap credit? If the answer is no, you're looking at malinvestment. The Austrian Business Cycle Theory says this matters because all these malinvestments will eventually be revealed as unsustainable. The resources consumed, the labor, capital, materials, were directed toward projects that can't survive in a normal interest rate environment. When that revelation comes, that's the bust. If this analysis is clicking for you, if you're starting to see the patterns Mises identified everywhere in today's economy, hit like so more people discover this framework for cutting through economic confusion. Here's where Austrian Business Cycle Theory gets predictive. Once you've identified artificial credit expansion and recognize a malinvestment pattern, Step 3 is understanding why the boom must end and what the correction looks like. Mises was adamant about this. The bust isn't caused by external shocks, animal spirits, or psychological panic. It's the inevitable consequence of the boom itself. The artificial boom creates conditions that make correction mathematically necessary. Why? Because of a brutal reality. You can manipulate prices, but you can't create real resources through monetary policy. Think about what actually happened during the boom. The Fed created trillions of dollars and made credit cheap. This directed labor, materials, and capital toward long-term projects that appeared profitable at artificial rates. Developers built luxury apartments. Tech companies hired thousands of engineers. Construction crews worked on commercial real estate. But here's the problem. All those resources came from somewhere. The workers building luxury apartments can't simultaneously build affordable housing. The engineers working on an app that loses money can't work on productivity-enhancing software. The materials going into that speculative office building can't go into needed infrastructure. The artificial boom caused a systematic misdirection of scarce resources toward projects that only make sense at manipulated interest rates. Eventually, reality intrudes. This happens through several mechanisms. Mechanism 1. The Fed stops expanding or raises rates. They can't keep rates at zero forever because it creates runaway inflation, which we saw in 2021 and 2022. When they raise rates, suddenly all those projects dependent on cheap credit become unviable. The monthly payment on that $500,000 house just jumped 40%. The startup that could refinance debt at 2% now faces 7%. Projects stop making sense. Mechanism 2. Price inflation reveals the illusion. All that printed money eventually shows up in prices. When consumers' real purchasing power declines, demand for the boom-era products falls. The luxury apartments sit empty because renters can't afford them. The retail stores built during expansion close because customers are tapped out. Mechanism 3. Malinvestments can't sustain themselves. Remember, many boom-era businesses only exist because of cheap credit. When that credit tightens, they can't cover costs from revenue. Layoffs begin. Bankruptcies accelerate. The weakest companies fail first. But failure spreads as their collapse affects suppliers and customers. Here's what the correction looks like in practice. You'll see unemployment rise, especially in those sectors that expanded most during the boom. Construction, technology, finance, real estate. These aren't random job losses. They're the market reallocating labor away from malinvestments toward genuine productive use. You'll see asset prices fall, sometimes dramatically. Houses that sold for $700,000 at peak might drop to $500,000. Stocks that traded at 50 times earnings might collapse to 15 times. This isn't destruction of real wealth. That already happened during the boom when resources were misallocated. This is accounting correction. Prices returning to levels justified by fundamentals. You'll see business failures, especially among zombies and speculative ventures. Companies that survived on refinancing cheap debt suddenly can't make payments. The market is cleaning out malinvestments. Painful as that process is, you'll see the mainstream economists claim nobody could have seen it coming. They'll blame external factors: a pandemic, a war, irrational exuberance, greedy businessmen, insufficient regulation. Anything except the actual cause. The central bank's artificial credit expansion that created the boom. But you'll know better because you understand the pattern. Here's your practical application. Look at current economic indicators not through the mainstream lens of is the economy growing, but through the Austrian lens of are we in boom or correction? Rising unemployment in tech and real estate? That's correction, not random bad luck. Falling asset prices? That's healthy adjustment, not crisis to be fought. Business failures among unprofitable companies? That's resource reallocation, not economic catastrophe. Mises would tell you the correction is necessary and ultimately healthy. It's painful because the boom-era malinvestments consumed real resources that are now lost. But the correction realigns the economy with reality. It puts resources back to productive use. It liquidates the errors made during artificial expansion. The worst thing policymakers can do, and here's where Mises becomes prophetic about our current moment, is try to prevent or delay the correction, because that just perpetuates the malinvestment, consumes more resources, and makes the eventual correction even more severe. Now we arrive at the most important step, using Austrian Business Cycle Theory practically in your own life. Because Mises didn't develop this theory for academic interest. He developed it so people could understand what's happening to them and make informed decisions. Let me be clear about something. I'm not giving you financial advice. I'm not telling you to buy or sell specific assets. I can't know your personal situation, your risk tolerance, your financial goals. What I'm doing is teaching you how to think about economic conditions using Mises' framework so you can make decisions appropriate for you. Here's how Austrian Business Cycle Theory applies to personal finance. Decision 1. Housing. You're considering buying a house. The mainstream advice focuses on: can you afford a monthly payment? Is your job stable? Do you have good credit? The Austrian analysis adds: where are we in the boom-bust cycle? If we're in late-stage boom, artificial credit expansion, elevated home prices, speculative buying, you might wait. If we're in correction, prices falling, inventory rising, credit tightening, that might be your opportunity. Right now, 2024, interest rates have risen from historic lows, but prices haven't fully corrected yet. Many markets show classic late boom signs. Prices still elevated from the cheap credit era. Inventory building, buyers waiting. An Austrian perspective suggests maybe this isn't the moment to stretch financially for a house that's still priced for 3% mortgages when rates are 7%. But, and this matters, if you need housing, you need housing. The Austrian analysis just adds context about whether current prices reflect sustainable conditions or artificial boom dynamics. Decision 2. Investing in retirement. Your 401k advisor tells you to stay the course and invest for the long term. That's not wrong, but it's incomplete without understanding cycle position. Austrian analysis asks, are stock valuations reflecting genuine productivity and earnings, or are they inflated by a decade of Fed money printing and near-zero rates? Are the companies you're invested in viable businesses, or zombies sustained by cheap credit? This doesn't mean you sell everything and hide in a bunker. It means you might adjust your allocation. Maybe less in speculative growth stocks that have never turned a profit. Maybe more in companies with real earnings, actual cash flow, pricing power in inflationary environments. Maybe holding more cash than usual if we're in late-stage boom, even though cash doesn't earn much, because cash becomes valuable when assets correct. These are decisions you make with appropriate professional help. The Austrian framework just gives you better questions to ask. Decision 3. Career and business. You're offered a job at a high-flying startup that's raised millions in venture capital but hasn't made a profit yet. Great salary, stock options, exciting work. Austrian analysis asks, is this business sustainable or is it malinvestment? Can it survive in a normal interest rate environment, or does it need continued cheap credit? If we're heading into correction, will this company still exist in 2 years? Or you're thinking about starting a business. Should you borrow to fund expansion? Austrian cycle position matters. If we're in late boom, maybe bootstrap and grow slowly. If we're in correction and you've saved capital, maybe that's when you expand, buying distressed assets cheaply, hiring talented people who are laid off from zombies, positioning for recovery. Decision 4. Debt management. You have student loans, car payment, maybe some credit card debt. The mainstream advice is generic. Pay off high-interest debt first. Austrian analysis adds, how vulnerable am I to cycle correction? If we're in late boom heading toward bust, job security matters more than usual. Maybe paying down debt faster and building emergency savings becomes priority, even if the math says you could earn more investing elsewhere. If correction has already occurred and you've maintained employment, maybe that's when you take calculated risks. Rates might be favorable, asset prices reasonable, competitive pressure reduced as weaker players failed. The pattern you're learning, Austrian Business Cycle Theory, isn't fortune-telling. You can't predict exactly when correction comes or how severe it will be, but you can recognize conditions, understand dynamics, and position yourself prudently. When everyone else is euphoric during boom, buying overpriced houses, loading up on speculative stocks, maximizing debt because rates are low, you maintain caution. When everyone else panics during correction, selling assets at bottoms, paralyzed by fear, certain the world is ending, you recognize it as necessary adjustment and potentially opportunity. This is what understanding Mises gives you, the ability to think countercyclically, while everyone else gets swept up in boom psychology or panic. Do you see it now? The pattern that Mises identified isn't hidden in complex mathematics or academic jargon. It's right in front of you, playing out in real time in the American economy. The artificial credit expansion. Check the Federal Reserve's balance sheet. Look at the money supply growth since 2008. See the years of near-zero interest rates. It's documented fact, not theory. The malinvestment. Walk through your city and count the empty luxury apartments, the zombie retail stores, the office buildings built for a work-from-home world. Visit a tech hub and ask how many companies actually make money versus how many just burn venture capital. The malinvestment isn't abstract. It's concrete and visible. The inevitable correction. We're watching it unfold right now. Tech layoffs, real estate slowdown, rising bankruptcies among over-leveraged companies, credit tightening, asset prices beginning to adjust. The boom is ending exactly as Mises said it must, for exactly the reasons he explained. This isn't conspiracy theory. It's not political ideology. It's cause and effect economics that you can verify yourself with publicly available data and your own observations. What changed for you in the last 30 minutes? You now have a framework that makes sense of economic chaos. When the news tells you inflation is transitory or unemployment is unexpected or recession is unpredictable, you know they're either ignorant or lying. You understand a mechanism that creates these patterns. You see the economy differently now. That housing boom wasn't organic prosperity. It was artificial credit creating unsustainable demand. That stock market rally wasn't brilliant investing. It was too much money chasing limited assets. The strong economy headlines weren't describing reality. They were describing the boom phase of a cycle that must correct. More importantly, you're not helpless anymore. You can't control the Federal Reserve. You can't stop the boom-bust cycle. But you can understand it, recognize where we are in the pattern, and make decisions accordingly. That's what Mises wanted. He didn't write the theory of money and credit to impress academics. He wrote it after watching the Austrian central bank create the exact dynamics that later destroyed the economy he loved. He wanted people to understand so they wouldn't be victims of manipulation, so they could see clearly and act wisely. You have that understanding now. Starting today, make this your regular economic practice. Once a month, check 3 things. First, the federal funds rate and Fed balance sheet. Are they expanding credit or contracting? Second, major market valuations. Price-to-earnings ratios, home price-to-income ratios, debt levels. Third, business news for signs of malinvestment correction. Layoffs in boom-era sectors, zombie company failures, speculative asset price drops. You don't need sophisticated analysis. Just track the pattern. Are we in expansion phase? Rates low, credit easy, speculation rising? Or correction phase? Rates normalizing, credit tightening, malinvestments being liquidated? Then ask yourself, given cycle position, what decisions make sense to me right now? In boom phase, this might mean resist FOMO on overpriced assets, maintain stronger cash reserves, pay down debt faster, be skeptical of can't-lose investment opportunities, avoid overstretching financially even though credit is cheap and everyone's doing it. In correction phase, this might mean look for opportunities in quality assets others are panic selling. Consider calculated expansion if you've saved capital. Maintain employment stability above all. Remember that the correction is necessary adjustment, not permanent catastrophe. You're not trying to perfectly time markets or get rich quick. You're trying to avoid being systematically exploited by boom-bust dynamics that hurt those who don't understand them. When your coworker asks why you didn't buy that overpriced house in 2021, you'll explain, I understood we were in an artificial credit boom. I waited. When your uncle panics about his 401k during correction, you'll explain, this is malinvestment being liquidated. It's painful but necessary. Don't sell quality assets at the bottom. You become the person in your circle who understands economics clearly while everyone else rides emotional waves of euphoria and panic. That's the practical power of Austrian Business Cycle Theory. Mises once wrote something that haunts me. There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. Do you feel the weight of that truth? Do you recognize how it explains everything you watched unfold? The 2008 crisis they solved by creating an even bigger boom. The inflation they denied until it crushed working families. The correction they're trying desperately to prevent right now? Imagine yourself 6 months from now. The economic news gets worse. Recession officially declared, unemployment rising, assets falling. Everyone around you panics, certain the world is ending. But you're not panicking. You're not euphoric either. You understand this is painful but necessary correction. You positioned yourself prudently during boom. You're not over-leveraged. You maintained emergency savings. You didn't buy assets at bubble prices. More than that, you understand what's happening. While others doom scroll financial news in confusion and fear, you recognize the pattern Mises explained. You know why this is occurring, what comes next, and how to think about your decisions. That clarity is priceless. That's what economic education gives you. This channel exists to teach you how the great economic thinkers, Mises, Hayek, Hazlitt, understood the world, not to make you an economist, but to make you economically literate, to give you frameworks for seeing through propaganda and understanding reality. Subscribe if you want more of this clarity. Next episode, we're analyzing why minimum wage laws hurt the very workers they claim to help, using Mises' approach to seeing the unseen. Until then, may you see clearly, think independently, and act wisely.